Just 2 months after it was restored, Twitter has suspended Kanye West's accounts once more on Friday after its founder Elon Musk claimed he had broken the terms of service prohibiting incitement to violence. Musk, who identifies as an ardent supporter of free speech or free expression, had praised the return of Kanye West to the stage in October. He said, quote, "I made an effort. Despite this, he once more transgressed our prohibition against inciting violence. Account suspension will occur late on Thursday," Musk tweeted. But we understand it's going to be only for 12 hours. Today, all eyes are on the U.S. payroll report, a non-farm payrolls report showing less than 200,000 could see more dollar selling. An NFP figure of 230 to 250 will see the greenback rebound strongly. Wages will also be scrutinized. Analysts are expecting an easing to 0.3% from 0.4. An increase of more than 0.4 will see the dollar take off. Lastly, the unemployment rate is forecast to be unchanged at 3.7%. A rate higher, say at 3.8, could see further greenback selling, while a lower U.S. jobless number could lift the greenback. In South Africa, South Africa's Finance Minister Enoch Godongwana says he believes there is a 10% chance that President Cyril Ramaphosa will resign. Godongwana was speaking to Bloomberg News and said he prays the president will stay on, but if he resigns, Godongwana said he would stay in his post as Finance Minister. Ramaphosa has been rumored to be considering resigning amid a corruption probe into foreign exchange in cash stolen from one of his farms. For more on these headlines, we cross over to London, where we're joined by Arise business analyst Bode Ososami. Good morning, Bode. Thanks for joining us. So what are the scenarios as we await the November U.S. non-farm payrolls later today?
Yes, good morning, Reuters. Well, indeed, the main issue is, of course, the broad impact on inflation. And what the numbers tell us, even though the central bankers are saying that hopes for a quick cooling in inflation pressures next year may actually be prove premature, but the numbers will also give us signals on a recession or sub-trend economic growth, and of course how this data is likely to influence the Fed, whether, of course, as the market hopes, it enforces a 50 basis points December 14 hike. Sometimes you just don't get what you want. Remember when they said inflation was transitory and it was not. Now they say inflation is peaking, and we shall see. But the hope, of course, is that the labor market is going to be less tight, and that participation rate will improve, and wage growth pressure will be alleviated. Yesterday, the Fed's Vice Chair of Supervision, Michael Barr, he said inflation is still far too high, although he admitted that, yes, they may shift to a slower pace of rate of increases. But going back to the labor market, if the labor market remains tight, putting pressure on wages, the Fed may have no choice but to be restrictive. That is to be more, to continue to be hawkish. Non-farm payrolls, the expectation is that we'll get an increase of 200,000 in November after 261,000 increase in October. The most likely scenario, I think, is that we will see the resilient, hot labor market beginning to cool somewhat in the sense of the mismatch between skills and jobs. But the jobs data will still fall far short of the turning point Fed Reserve officials are looking for to beat back inflation. But we did see Wednesday job openings falling in October, reversing a surprise jump in the prior market. Also on Wednesday, Powell said the drop in openings is a positive thing, but the job to workers gap is still about 4 million, and that gap is not going to vanish overnight in one reading. So let's see what happens. Of course, we've seen a lot of layoffs as companies across industries such as technology, finance, and real estate announce massive layoffs. Again, that could come to bear on these numbers. And we could also get a surprise scenario of a huge downside on jobs added, which will push the recession risk narrative and may encourage some level of dovishness. I doubt if an upside surprise is on the cards, where we see jobs added better than last month. There's a Goldilocks scenario, which I think is even less likely, with better participation rate on unemployment going down and calming wage growth, suggesting a steady growth that is not too high to trigger inflation, not too low for a slowdown. But I've learned that data can always surprise you. There's the usual divergence between reality in Main Street and Wall Street wishful thinking, which, of course, tends to dominate the headlines.
And speaking of headlines, OPEC been making headlines, oil prices as well. OPEC meeting ahead of the embargo and price cap on Russian oil. What are your thoughts with respect to the meeting?
Well, we had the EU tentatively agreed $60 per barrel, subject to Poland agreeing, but that was lower than what was previously rumored. And I think whatever cap you get, it certainly raises the chance of harsh Russian supply retaliation, which, and as you know, would lend support for oil prices. Crude oil is very volatile now, range bound between $80 and $90 per barrel for Brent, but with mostly the headwinds weighing on prices potentially going even down under $80, sensitive to the dollar, downcast China demand. And many are saying that the US economy may actually be weaker in 2023. We'll have to wait and see how that flows. But I suspect there's a 50-50 chance of seeing a symbolic but not significant production cut as the demand outlook looks quite subdued, or we could get a pause to have a better understanding of how the embargo and price cap on Russian oil will play out. The likelihood is that Russia is putting pressure for some kind of cut to get prices up. Russia's cost of production is just about $40 per barrel, which is still comfortable. Of course, it's like twice the Saudi Arabia's production cost, which is $17 per barrel. And of course, Saudi Arabia is the big winner here. But if Russia succeeds in pushing to get a modest cut to keep prices firm, the more conservative voices will, I think, try and cap that aspiration, especially given the subdued demand coming from China. But I must mention the EIA data that just came out this week. It showed commercial inventory in the U.S. down by 12.6 million barrels. Production stable at 12.1 million barrels a day, which is up 7.8% from a year ago. And strategic reserves also down 213.4 million barrels, which is 35% below what it was a year ago. So there's still some tightness in the markets.
Arise business analyst Bode Ososami. Bode, thanks for taking us through the headlines. We appreciate your insights as always.